everyone. Welcome to this wealthmanagement.com Fast Chat. I'm Shannon Rossick. I'm joined by Peter Higgins, head of fixed income and senior portfolio manager at Shelton Capital Management. Peter, thank you so much for joining me.
Hi, Shannon. Thanks for having me today.
Absolutely. So we'll be taking a fast but deep dive into how investors can take advantage of the current state of financial conditions. But Peter, before we really get into the weeds here, can you just provide us with an overview on how you view the current market environment for fixed income investing?
Sure, happy to. I mean, it might help by starting with a brief history. 2023 was advertised as the year of the bond in the press. And for much of that year, it certainly did not turn out that way. It was thankfully the fourth quarter of 23 saved the entire calendar year by posting a big rally, resulting in the ag being up about 5.5% for the year. So as we came into 2024, it wasn't as hyped up as in the press as the previous year. And that's probably because some of the market pundits worried that so much of those returns are pulled forward into calendar year 23. Now, market participants, however, came into 2024 a little bit too excited. And that was evidenced by the fact that the market was pricing in 5 to 6 cuts for the calendar year. And now the market is pricing in only 1 to 2 cuts. So as a result of that enthusiasm, prices sold off, and the ag index, which is a good barometer for core fixed income, is down about 2% year to date. But I think with yields over 5%, fixed income is an asset class that can't be ignored, which might be why we're talking today.
So how did the results from the last Federal Open Market Committee meeting parlay into your current view and your near-term outlook?
There's been a lot of action recently with the FOMC meeting and really kicking things off last October and then March and then just last week. But I remember having a conversation with your colleague, David, I think about 12 to 13 months ago. And I think I used the expression higher for longer. After a few head fakes, that phrase still rings true. Last week at the FOMC press conference, Powell admitted that he is lacking the confidence to start cutting right now, but he also signaled to the market that he has an unwillingness to raise rates. He has clearly insisted that rates are currently at restricted levels. But my argument for part of this conversation is going to be that financial conditions paint a very different picture. They've been loosening ever since the peak witnessed in late October, which was simultaneous with the FOMC meeting, and have bounced around, more recently, but have come off again and loosened since last week's FOMC meeting. So, the current view here is that rates will remain range bound until a real trend develops with either continued higher inflation or weakening growth and higher unemployment. One data point doesn't make a trend. Even Powell kind of ignored, January and February's data points, plural, and then he ultimately caved as the data became too impressive for him to hold the line. So I think until that trend really develops, we're probably in a trading range, and clipping an attractive coupon can be quite fruitful in this market.
Then how can investors take advantage of the current state of financial conditions then?
So with financial condition indices all continue to ease, it's opened the credit markets to primary issuance or new deals. So for public bond issuers, especially investment grade rated companies, volumes are at near record highs. Even as you go further down the spectrum to high yield issuers, they also have open access to the capital markets, except for the very distressed ones. And if the public markets aren't there, then private capital is plentiful, and it is an avenue for companies to access funds. So, one strategy we've been implementing in our portfolios is that we can capture total returns if we identify those shorter dated securities, which might be refinanced early, potentially even before their call dates. it's probably no coincidence that CFOs who survived the great financial crisis and the COVID era have been very conservative with their balance sheets. So if capital is available, even at more elevated rates, they're accessing the market. That's why we have record issuance in IG land and very strong volumes in high yield land. So my advice would be let me back up and just say, I come across a lot of clients who are attracted to what is known as short duration funds. So those funds might have a very diverse holding of shorter duration or maturities, and they might get lucky. They might stumble upon one of those bonds that refinances early, and instead of just getting the interest income, you're also going to get capital price appreciation for the total return. What we try to do, and what I would recommend investors, is to hire a more active manager. Here we could identify those bonds that we think have a catalyst to be being refinanced early. We can take more concentrated positions than maybe some of those shorter duration funds, which, as I mentioned, are more diversified. And as a result, we can enhance total returns. So that's kind of one strategy we play with here at Shelton.
Well, that's a great piece of advice. But I do want to ask, because one thing I've noticed is an increasing amount of, I guess, quote unquote, Fed speak. What are the market repercussions with the Fed governors continuously talking?
The chatter amongst the Fed governors goes straight to the top. And I think that was most evident when Powell himself pivoted during the October 31st press conference. And that sparked that tremendous fourth quarter rally. He even reiterated his willingness in March to cut at some point in 2024. But Powell is also someone who likes to form consensus. And with the inflationary data remaining sticky and growth strong, albeit weaker from Q4, but still very strong, very much stronger than most street economists predicted. Excuse me. The line of sight to get inflation from roughly 3% down to the targeted 2% levels has become blurred and is uncertain. I think at the end of the day, the economic data was just too strong. So the other Fed governors, rightfully took it upon themselves to speak up. And whenever there's uncertainty, there's volatility. And that's what we witnessed. The 10-year U.S. Treasury yields increased by, I think, about 50 basis points in the month of April alone. And it wasn't exactly a straight line. So I could even argue that, hey, if Powell didn't pivot in October as vocally as he spoke, then we may not have even seen such a near round trip, to 5% down to 3.8% where we ended 2023 and back up to where we are today. Maybe all that volatility could have been eliminated.
Well, put a positive spin on it then. How can investors take advantage and benefit from market volatility?
Yeah, I think the simple answer is active management. It's not just the trajectory of rates on a month-to-month basis, but it's the intraday volatility and weekly price movements that can be captured by choosing, the right active manager and bypassing ETFs and or more passive management styles. I think those passive styles, were great when the trend was solidified. And at the end of the day, we had come off of a 40-year rally in rates. We're no longer in that kind of market. There's going to be volatility, and I think active managers can create alpha above and beyond the benchmark indices.
And what impact does all of this recent volatility have on market valuations?
So this is where the story gets a little muddy. Perversely, the weaker the credit ratings, the better the returns have been. And the volatility of rising rates has penalized and impacted the investment grade rated securities the most. And historically, the higher the rating, the more correlated it is to interest rates anyways. On top of that, equities have been largely immune year to date from the rate move. And frankly, the economic data has been supportive of growth. So as a result, credit spreads have not widened, and they've continued to tighten. So we've got this issue on valuation where yields are very attractive from a historical context, but spreads leave little room for error. So the approach we've been taking here at Shelton is that instead of just buying the market, the best value can be uncovered by selecting securities with idiosyncratic risk, and identifying positive catalysts. If we can find those securities that are less correlated with the broader market indices, have a story, see it play out, then we're going to capture greater total return than the overall benchmarks and create alpha for our clients. So that's kind of what we're up to. I saw a stat the other day that is quite interesting. Historically, when the market references investment grade, spreads are under 200 basis points. Obviously there's the rating component to investment grade, but generally speaking, IG is under 200 basis points. Well, nearly half of high yield issuers right now are under 200 basis points. So buying the market just isn't the right strategy going forward. I think being selective and identifying names with idiosyncratic risk is the way to go.
Well, I appreciate you painting the picture and your insights today, Peter. Great conversation and looking forward to hearing more in the future.
Great. Thanks for your time, Shannon. Appreciate it.